Hey, Middlebridge. Are you ready to learn about credit? Me too. Well, almost. Now I'm ready. Let's do it. So, the purpose of today's video is to talk about why we use credit. And I want to start real basic. So, hang with me for a minute. In our everyday lives, we all pay for goods and services. I'm sure you've heard that phrase a bunch and want to just quickly break it down so everyone's on the same page. So, goods are things, so usually stuff you can touch. It's like footballs and sandwiches and cars and kazoos. Services are experiences or opportunities or utilities like concerts or massages or doctor's visits or college semesters or electricity for your house or kazoo lessons. You're paying for the experience of learning it. So we pay for these things, these goods and services, with money. And normally the exchange of money for the good or service happens at the same time. And credit is how we describe situations where there's a delay between getting that good or service now and paying for it with money later. So that's pretty much the biggest definition of credit. And we're going to look at that a little bit more. So the three types of credit that I'm going to talk to you about today are bills, loans, and credit cards. And I'm actually going to give you a little sheet that depicts everything that I said, and I'm going to use some internet magic to make it happen here as I talk about it. So hopefully there'll be a direct connection and you can look back at the sheet if you want to recap anything that I said. But we're going to talk about bills, loans, and credit cards. Now, the big question that we're going to start with is why would we use any of these credit methods in the first place? Why don't we just pay with the money that we have? Well, first, if you think back to when we talked about credit scores, it's kind of that chicken or the egg situation, right? You need a good credit score to get the credit. And so if we kind of get halfway between the chicken and the egg, we got to start somewhere. And with credit, that means that we've got to start building our credit. So we might be taking out a credit card so that way we can prove to lenders in the future that we're responsible. Ta-da! I did it in the past. I can do it in the future, right? Huh? Hopefully. That's what they bank on anyways. So aside from the need to build credit and prove that you're creditworthy or trustworthy, we also have two other big reasons why we'd be using credit in the world. And the first one is so that way an appropriate bill could be calculated based upon how much money you owe for a good or service. I'll talk about that more, but just previewing right now. The second situation would be you have the flexibility to spend money the way that you want to and when you want to spend it. This is typically thought of with big purchases with loans. And again, previewing. So, three reasons why you might need credit. There's three. Sorry, I didn't think that one through. Three reasons. That's a way better delivery. Three reasons why you might need credit. First one is to increase your credit score. The second one might be so that way the lender or service provider has time to calculate your bill. And the third one might be the flexibility to spend money how you want it and when you want it. So I'm going to talk to you about these three things, bills, loans, and credit cards, using the same framework every time. We're going to talk about the now, and then we're going to talk about the later. Say that it's that difference there. That's the whole concept of credit. There's a now and a later. When you're just buying something, that transaction happens at the same time. You get the thing, and you hand over the money at the same time. One for one. In this situation, that delay creates that now and later situation, so that's what we're going to be talking about with each one of these. So bills. Bills are typically situations that are about the service provider being able to calculate the right bill for you. So you would get a service from the service provider. That might be electricity for your house. It might be, going to the doctor and having some medical service done for yourself. You're going to get that service in the now. So with bills, even though you are not directly given money for this situation, you're given a good or a service, that good or the service is worth value. So we count it like money, especially in the eyes of the service provider. They are, selling that thing to you. They're selling you the electricity for your house. So they definitely see that there's value to that. It's worth something, and so they're going to charge you for it. So even though you're not getting money in this situation, so that way, like in a credit card, you could spend it however you wanted, or a loan, you could go ahead and use that money for a car or a house. This is a situation where you're getting something of value, so it still counts as credit. And we're bringing it up today because some of these situations of important bills do affect your credit score. So with bills, the later means that whenever the term is over, usually a month if we're talking about something like a electricity bill that repeats again and again on a monthly bill, once you have that time period, they calculate how much you owe based upon whatever happened. Electricity, how much electricity did you pay? They put it through the formula and they tell you how much you owe, and then you get the bill. If it's a medical bill, then they figure out, okay, how many fracture things. I don't play a doctor on my YouTube videos. Well, they did doctory things to you, and they figure out how much of the doctory things they have to charge you with money. So whatever the bill turns out to be for whatever service you had, it's typical that you're expected to pay that all at once, which is why we say bills are usually single payer credit situations. You're expected to get that bill and pay it all down to zero at one time. Single payment, single payer credit. Now on to loans. Loans exist primarily so you can buy really big things with money that you typically don't have yet. So a good example might be a car. $45,000, you may have it. You might have better plans for that $45,000, and so you decide to take out a loan. Okay? In the situation of a loan, you get a large sum of money at once, oftentimes for a very specific purpose, like a car, and usually that money is not given to you directly, it's given directly from the lender, the company that's giving you the loan, and it's put towards that purchase, whatever the purpose is that you're getting that loan. In the case I'm talking about, it would go directly to whoever's selling you the car, the car dealer. So with most loans, you get all the money up front and it goes directly to the purpose that the loan was approved for. Car loans, mortgages, business loans, education loans, and then payday loans, which are a little scammy. They're typically very expensive. We'll talk about those another day. But in all these situations, you're usually saying a specific purpose that you need the money for, and all the money comes at once, and that's that now situation. So with a loan, the later is a situation where you're making regular payments on a term. So that is the length of the loan, the amount of time that you have calculated with your lender about how long it's going to take you to pay back all this money. You would make these regularly scheduled payments over the entire term of your loan. It'd be really predictable, and you would pay them and pay them and pay them until you pay it all back. So you would be paying it all back, whatever the cost of, let's say, the car was, but you'd also be paying interest. So you'd actually be, in the long run, paying more than the value of the car. You'd be paying the value of the car plus whatever the calculated interest was. That's that fee for the pleasure of getting the money up front for the thing that you wanted. If you just paid cash for the car, you wouldn't have to pay the interest. But the lender wants something out of the deal. They're giving you their money, their opportunity, handing it over and allowing you to do what you want to do with it and trusting you to pay them back. So their price of trusting you and giving you the money when you want it is interest. Because you pay these back in small pieces, loans are thought of as installment credit, small installments until you eventually pay the whole thing back. Yeah. So credit cards are the third and last example of credit that I'll be talking to you about today, and they are the most flexible. They're also the most dangerous for that very reason. Credit cards, usually you can think of, they exist so that way you can buy smaller things with money that you may or may not have at the moment. They're also usually the thing that you use if you want to prove your credit worthiness. You get a credit card so that way you can have that experience under your belt and that proof with your credit history to prove that you are trustworthy to get more credit. Now, credit cards are a little funky because whereas the other ones we were talking about a now and a later, credit cards get a lot more mushy. The now and the later kind of overlap, which is why we typically call this revolving credit. That feels right. So the closest thing to a now with a credit card is that when you first start out, you're given a limit. And the limit is how much you can owe at any given time. But you have the flexibility about how you want to spend it and if you want to spend it. So you might have a credit limit of $1,000. You don't have to go, and you shouldn't necessarily go and spend $1,000 all at once. You have the flexibility to spend up to that $1,000 and then pay it back. Also very flexible. So the now of a credit card is the most loosey-goosey of all of them. This is a way more fun dance. So, as I previewed, that interconnectedness of the now and later for credit cards is pretty funky. So the later is really meeting a due date that happens every month, and as long as you make a minimum payment by the due date, then the credit card is happy with you, which means that you do not need to pay off all of the money that you spent over the course of a month. You only have to pay the minimum payment, minimum amount back to them, which is an amount that they set. However, you will be charged interest on whatever balance you have for the credit card. Ugh. So it is not at all in your favor to play the game this way. However, it is a flexible game, so you can use this card and this money that's available to you for things like emergencies. You know, big repair in your car that you didn't have coming, you don't have the money to fix it, you can put it on your credit card. Just know that that repair for your car is going to cost you a lot more in the long run because you're paying for the whole repair plus the interest that the credit card is going to charge on top of that. The way you calculate interest is the longer you owe the money, the more money you owe, and the higher the interest rate. All three of those factors mean that you'd be paying more interest when those things go higher. Ugh. So you want to keep your balance very low. You want to pay off your credit card as often as you can, and you also want to try to get credit cards that have really low interest rates. And you do that by having a great credit score. Credit cards are called revolving credit because of this cycle that happens where you get to charge things, use your card to pay for stuff, right? And then the balance goes up, and then you make those payments to have it go down. So it's revolving, it's always changing as you're able to access that credit card all the time. That's because those now and later situations are pretty overlapping with a credit card. It's not as cut and dry. Speaking of dry, thanks for hanging around for another one of my silly videos. I miss you guys. Take care. Oh.